Yeah, so this is obviously the really big warning that we've had so far, probably the biggest and certainly most stark in terms of where that's coming from. A really big core driver of this is that the oil price is weakening quite substantially. So when we look at why that might be happening, a big reason for that is because it means that demand isn't going to be there, or it's viewed to not going to be there. So that's a really big one. We have Brent crude hovering at about $91 a barrel. It's declined for the third week in a row. So there's big questions hanging there about economic activity going through. And also the other really big one is we actually had a more positive data set than expected coming out of the US earlier this week. So we saw retail sales rise slightly, which was much better than expected. But what that's actually done is it's increased the likelihood of more aggressive rate hikes in the US from the Fed. And what that means is that actually that increased monetary tightening means that concerns about stifling economic growth are even more stark than they were. And that is a big reason also behind the World Bank's stark warning today. The policymakers have an enormous balancing act on their hands. I think at the moment, it's fair to say, particularly Europe is probably on an unavoidable slipway into recession. I think that's fair. Exactly when it will land is hard to say. What we really need to be asking instead is how deep these recessions are going to be, rather than if they can be avoided in certain areas. And the biggest thing that policymakers can do to stop that from happening is to not hike interest rates too aggressively. At the same time, of course, inflation is a huge problem that has to be brought under control. So interest rate rises are needed, but the speed and scope of those are what really needs to be watched. But as I said, the core message really is recession now is more likely than it is unlikely. The question now is how to make those recessions as shallow and as easy to get out of as possible. In terms of the effect on the consumer base and also businesses when it comes to looking at the current economic landscape, the full effect is going to depend squarely on how deep those recessions are when they arrive. We know that for instance, a very deep recession is going to have an enormous effect on the workforce and consumer confidence more generally. The big one, really, perhaps unsurprisingly, to watch is what would happen to interest rates in the scenario where things are very, very difficult. Are we going to then see things trimmed once more? But what I would say as well is that consumer behaviour is already shifting pretty dramatically, particularly in the UK. We've had some really disappointing retail sales come out this morning. Sales have fallen 1.6%. And what we're actually seeing is consumers are already shifting to lower value items. They are changing how often they shop. They are changing how much they buy per shop. And they are substituting their normal items for cheaper alternatives because the household budgets simply can't support previous lifestyles. So that's really stark and is likely to continue for some time, in my view. And I think particularly consumer discretionary stocks, so non-essential items, are in for a really, really difficult few months at the very least. But what I would say as well is that actually when we look at, it seems like a very long time ago that inflation was that low single digit percentage that we're used to. And I think it's going to take quite a long time for that to come back down to any normal level, unfortunately.